status, your race, religion, gender, or geographical location. It didn't even care that you were living in the most beautiful part of the world, the Caribbean, and certainly didn't care that Anguilla was one of the leading tourism destinations in the world. It came to our shores, and we felt the economic shock immediately. Our main industry came to a virtual standstill, leaving thousands of Anguillians of Anguilla's workforce unemployed and vulnerable to negative financial impact. As a result of this, NCBA, under the guidance of ECCB, leaped into action to offer its valued customers impacted by the advent of the pandemic a moratorium for 3 months in the first instance. However, as the magnitude of the pandemic unfolded, it was necessary to further extend said moratoriums for an additional 3 months, and consequently until December of 2021. It is our duty as a financial institution to provide the best financial guidance to our customers. In light of this, we will be embarking on several series of financial seminars, and we felt it necessary to start with the moratorium seminar as we are quickly approaching the end of the moratorium period. I would like to take this opportunity to welcome everyone here. I would like to recognize in our presence our chairman of the board, Mr. Carl Harrigan, as well. Welcome, Mr. Harrigan, and to everyone that is listening via social media. I would also like to welcome our CEO, Ms. Francois, for coming here and presenting this seminar. As such, I will move right into introducing our CEO. Ms. Charmaine Francois is the CEO of National Commercial Bank of Anguilla Limited. She is a well-respected senior banking professional with over 20 years of experience in bank management, investment banking, and business development. She brings extensive regional banking experience, having worked in several markets: St. Lucia, St. Vincent, Barbados, Trinidad, and most recently, Montserrat. In 2003, she participated in the divestment of 15 million in Anglex shares for the government of Anguilla. Prior to joining the NCBA team, she held the position of Assistant General Manager of the Bank of Montserrat Limited for the past 5 years. Ms. Francois also serves as a director on the boards of the Eastern Caribbean Home Mortgage Bank and the Caribbean Credit Card Corporation, 4Cs, both based in St. Kitts. She has worked in every facet of the banking industry, to include retail, corporate, wealth management, and investment banking. She also has been involved in startups, mergers, and acquisitions, as well as has worked with regional financial institutions with assets of over 1 billion and has played an integral role in delivering more than 500 million in new business during her career. In addition, in 2012, Ms. Francois was the recipient of the prestigious Corporate Leadership Award from the St. Lucia Chamber of Commerce for her outstanding performance in leading a local financial institution. Ms. Francois holds a Bachelor of Science in Accounting and Statistics from the University of the West Indies and completed postgraduate studies in Business Administration from Manchester Business School in the UK. She is an accredited director from the ICSA Chartered Secretaries Canada. In addition, Ms. Francois completed the registered principal and representative licensing examinations to operate on the Eastern Caribbean securities market. She's the mother of 2 children, a role she enjoys foremost. Ladies and gentlemen, let us welcome Ms. Francois to make her presentation.
Good evening, good afternoon, good evening. I'm confined to a desk, and I love to walk around. I don't like to be confined, but I'm told that I have to sit today. So I'm hoping I can be as engaging, while I'm seated. So this evening, we're going to be talking a little about moratorium. As Casilla has just mentioned, we are running a series of seminars. We've started that series in 2019, late 2019. We took a break. There's some, halt in 2020 as a result of the pandemic. But we feel it's necessary that we push forward. We believe financial literacy is extremely important, particularly now. And so that is why we are carrying on that mandate to ensure that we build the savviness of our communities, the investors in our communities. I want to recognize my chairman. I know Casilla did that, a little while. Mr. Harrigan, it's really nice to see you. And Director Vida Lloyd Richardson. It's nice to see our directors present with us, this evening. We also have a few of our staff members. I see some of the credit team, and also I see Karen and Natasha here with us, and we'll see a few more join in. And it's always a pleasure to see. I see some familiar faces from previous sessions. So it's always nice to see our customers coming out to our sessions, sessions like this. So what I will do, Ivan, are you ready for on social media? I just want to make sure our persons listening. Social media is on. Okay, good. So what we're going to do now is to jump straight into the presentation. We're trying to get the screen, the project on this screen at the back for a larger screen. I guess we'll have to move this eventually. But what I will do is to ensure that whatever we present, it's clear, notwithstanding we don't have the visual present, So just to speak on just to give some global update on COVID-19. Global prospects remain highly uncertain 1 year into the pandemic. So 1 year into the pandemic, there's still a lot of uncertainty around COVID-19, the pandemic. When will it come to an end? So that uncertainty still exists. Notwithstanding, based on the recent update, just reading some information from the IMF, and that was dated April 2021, the IMF is saying the global economic growth is expected at a rate of 6% for 2021. Moderating to 4.4% to 2022. So instead of a contraction, which we saw in 2020, we're looking at an expansion for 2021 into 2022 and beyond, notwithstanding the uncertainty that exists. Now, those projections are based primarily on the additional fiscal support that we are seeing by major economies, and also the anticipated vaccine-powered recovery expected in the second half of 2021. A lot of that growth is really reliant on the uptake of the vaccines, And so a lot of, as I said, those numbers are driven a lot by vaccine uptake and additional the fiscal support that is given by the governments of those major economies. So the outlook, as I said, again, to basically bring out that point, and not just on a global, when you drill down into our parts, we are heavily reliant on the tourism sector for most of our small economies. And so the battle between the virus and vaccines, that who wins that battle will decide our fate. And also the effectiveness of economic policies deployed and the evolution of the financial conditions in terms of the affected sectors and households as a result. Our smaller economies have, as I mentioned, are heavily dependent there's heavy reliance on the tourism sector, and that is the sector most affected by the COVID-19 pandemic. Just to give you, okay, so we have that, just let me pause a minute. Can we move, we cannot move this, because this side cannot see, so can we move this? Because I would like to show the chart in terms of the economic growth numbers for the Eastern Caribbean Currency Union. You just tap down for me. So everyone can see? Yeah? Okay, so I think that's better. They'll see you. I think you may, if you want to see, you may have to move. Okay, so the chart basically shows the economic growth rate for the ECCU region. From 2017, what we can see here, there was expansion. The year 2020, which is the COVID year, the economies contract collectively at a rate of 14.03% for 2020. And all of that is really driven by the impact of the pandemic. Yeah? What we've seen, go back, Casilla. For 2021, there is a projection. The projection is an expansion of about 3.4% for 2021. So for this year, we are projecting, based on the numbers coming out of the ECCB, an expansion of 3.4% for the region. So let's go down. The other impact of the pandemic is on our debt to GDP ratios. What we see in here for the ECCU, if you look back at 2019, as a grouping, our debt to GDP ratio was at 67%. In 2020, that's 2019, sorry, and 2020, that ratio went up to 86%. And a lot of it is to provide support, to be able to function during that period. So we see what is happening to our debt levels on a collective basis, and we also see what is happening in terms of our GDP growth. Let us look now at Anguilla. We had a positive growth. If you notice, there was a contraction after Irma, but things started to pick up in 2018, 2019. But here comes COVID in 2020. The economy contracted by 27% in the year 2020. And I'm sure all of us felt it. Yeah? And a lot of that was driven by the tourism sector being shut down completely. Yeah? What we project in, based on central bank numbers and looking at Ministry of Finance and what is happening, a sense of the economy in 2021, there's an expansion projected of 11% for 2021. But a lot of that is reliant on the vaccination uptake. Yeah? A lot of those numbers is the reopening of the sectors. The primary sectors need to reopen in order to achieve those numbers. Now we see what is happening in our sister island. That will have implications for all of us. Yeah? So those numbers, you'll see those numbers moving as the weeks and months go by, particularly on an ECCU level. Casilla? Okay, so our debt to GDP, also we see some movement. Now just to mention the benchmark for the region, just similarly for individuals, we have a debt to income ratio that an individual should not exceed of 45%. That's the benchmark. For governments, the benchmark is 60%. And so when we spoke of the ECCU, remember we spoke of over 80%. So we're already outside of the benchmark. In terms of the Anguilla is currently at 63, moving from 48 to 63%, just marginally outside of the benchmark. But as a grouping, we are, we are over 80%, which is significantly outside of the benchmark. But that 60% is a goal, a 2030 goal for the governments to achieve that debt to GDP benchmark, ratio benchmark. Yeah? We can go down. So Anguilla COVID-19 impact. So as we mentioned before, because of the pandemic, what we've seen is that, and our main sector being affected, that has significantly impacted the cash flows of not just individuals, but more so our businesses. So our business, as a result of our businesses being affected, that would trigger down to our individuals because there would be salary cuts, job cuts, etc., coming out of that. 1 year into the pandemic, and the hotel and restaurant operations in Anguilla have not rebounded. There have been little recovery, and in some cases, absolutely no recovery. Yeah? And we agree? That's what we're seeing. The customer segments that continue to be most vulnerable are the workers employed and commercial enterprises in those sectors that I mentioned right here. Where we have direct investment in tourism, that's hotel, restaurant, but extending into importation, villa, car rentals, and real estate. All those sectors we see these are the sectors that are primarily, and I'm sure the insurance sector will tell me that we also affected. It's all sectors. But I'm speaking to the major sectors in terms of the slides here. As a result, a large percentage of our customers still remain without income. We've seen a gradual improvement, very marginal improvement. But we see more, very significant numbers, and we'll speak to some of the numbers or the value of moratoriums that we had to offer as a result. Yeah? We also see our businesses, the cash flows being affected because we had to give a lot of cash flow support just to ensure that our businesses can ride, that tide, to ensure that there is survival. Because once our customers fail, what happens? We fail too. Yeah? So we must work with our customers to ensure that collectively we succeed, this pandemic. We come out strong after this pandemic. And economic recovery for Anguilla and the region is highly dependent on the success of the vaccination programs. I mean, I'm no expert. I'm not from the Ministry of Health, so I will not be speaking about anything technical around vaccination or because I don't know. I mean, I took my shot because I know it's important for me, for you, and the economy. So I took the shot because of that. So the vaccination is critical. Achieving herd immunity is important in order for us to move from where we are. In order for our persons to regain employment, for the sector to open, so that the economy can rebound. And if that does not happen, then we are going to be in serious problems. And we're going to be talking later on in the presentation about the moratoriums will come to an end. The central bank, as regulator, has given the banks the authority to extend the moratorium to September 30th, 2021. So come September 30th, the moratoriums will come to an end. That's 18 months of moratorium. As bankers, we already started discussion at the ECCU bankers level to see if at all moratoriums can be extended, if things that, don't improve. But for how long? So vaccination is very critical for us, so that we can remove. And so we come to that slide, and if you notice, NCBA supports vaccination. We teamed up with Digicel in terms of the mobile vaccination, just to support the initiative. What I expected on Friday when we had the mobile vaccination, I was expecting to move that number from where it was at 5,008, I think that's where it is currently, 5,857 to 12,006 on Friday. But they told me it's 24 persons got vaccinated on that day. Only 24. So, we have to keep that mobile vaccination moving. We all have to push vaccination. I'm still alive. How many of us took the vaccine? And any of us dead? Huh? I know when the call was made and to the bank, and they told me that I can bring all my managers, how many staff, to get vaccinated. And so I made a few calls to my managers, and everybody's like, oh, no, Miss Francois, no, we're not ready. So I said, okay, so I will be the guinea pig. I will go. Once I survive, everybody will follow. So it was 2 of us on that day going and get the vaccine. Now I think most of our managers, I'm hoping, Tasila, Dodo, yeah? That's in order. Almost there, you see? Yeah, so we have to be serious about that. I mean, there are persons that have conditions, conditions that may prevent them. That's fine. But if you are healthy and that, there's no reason why not to. But again, it's personal choice. I'm not forcing anyone here. But we have to know the implication of not, not supporting the cause. So right now we are at 46% based on the target of 12,600. We are at 46% vaccinated in terms of the population. So we have work to do to get us to that target number of 12,600. So NCBA COVID-19 relief program get at providing financial relief to affected customers. So you can go down. Very early, as soon as the whole COVID hit our region, that information hit the region, early March. I remember rushing back to Anguilla on the 14th of March. The borders closed, I think, that very week. And so as the People's Bank, the bank who cares about the community, the welfare of the community, we saw it prudent. I think we were the first to start to come out with the moratorium immediately. We didn't wait for April. We started from immediately March 2020. Yeah? And to date, we've given 100 million in moratorium support. 100 million in moratorium support. Yeah? And so the number of customers is over 200, about 250 customers. And that is business. We'll show you in terms of the percentage, what commercial represent, retail represent, etc. But it just shows you how, and not just performing loans, we also extended it to persons that were not performing. Like the loans that were in arrears up to 89 days, we extended the moratorium to them. Even we had a few customers that were non-performing. When we say non-performing, in default, over 90 days they've not paid. What we did, where persons have shown consistency in payment, we worked with those customers and put them on the moratorium. So as soon as the economy kicks back, they can just continue on. They will not be penalized. Yeah? So as the People's Bank, we believe in working with our customers to ensure that it's a win-win at the end. Yeah? So the moratorium on loans, and I said it started at March, it's ending in September, so that's 18 months. Now, not everyone is on an 18-month. So that's the maximum period right now. Now, if, for instance, some persons took it for 3 months because they may have they had some financial issues over the first few months. Some persons took it for longer. Some persons are still on it, maybe up to September because they're unemployed. But and again, maybe I'm fast tracking the presentation, but we'll get to that. The moratorium will be offered to both individuals, or not will be, but it's being offered to both individuals and commercial entities. So we not just individual, but also companies affected by, and remember, affected by COVID-19. So it's not automatic. If you're employed, the moratorium is really not for you. Only if you have members of your family that is affected, or there's a business flow that's no longer coming, then your cash flows have been affected, then you would qualify to be part of that moratorium program. Loans in arrears up to 89 days qualified under the program. Customers whose loans were in arrears, as I mentioned before, there were no penalties for persons that were prematurely closing of CDs. We did not apply the penalty. We also did not apply any late fees over that period, and we continue to not apply late fees as a result of the moratorium. Affordable mortgage loans, what we started because of the current environment in August of last year, running right to December, we offered a loan program, which is the Come Home program, that a lot of you participated in. And that Come Home was to offer a package in the current environment for persons that qualified for such financing. And that was for home construction, home purchase, and land purchase. We offered 100% financing, lower interest rates, etc. And quite a few persons today are building today. Quite a few persons have purchased land. And there's still progress happening, notwithstanding the current environment. Yeah? So that's part of the relief. So what is a loan moratorium? So that's why we are all here. We believe in educating our persons to understand, if you're on a moratorium, what does that really mean to you? So a moratorium is a period during a loan term when the borrower is not required to make payments, that is interest and or principal payments. So you can have a full moratorium where you're not required to make any payments at all, interest and principal, or you may have a partial moratorium where you're making interest payments but not principal payments. Yeah? It is basically a temporary relief measure granted to customers for a specific period of time, which is called your moratorium period. So it's not something that is permanent, it has a fixed period of time. So if you notice, for those of you who on a moratorium program, you would have had to sign a moratorium form that would indicate how long you are on that program. If it's 3 months, 6 months, or further extension until the end of the stipulated moratorium. Moratoriums are offered in response to temporary financial hardship. So in the hardship we're talking about here now is because the hardship posed by COVID-19. Yeah? So what we in normal times we would have offered moratorium when in the commencement of a project, in the commencement of a construction, you're constructing your home, you would have gotten a moratorium on principal payment. So all you pay is interest over the construction period. In the case of a natural disaster, likewise in the time of Irma, the bank offered moratoriums, a full moratorium during a period of disaster. Similarly for a pandemic. During the period of the moratorium, interest continues to accrue, and that's the point we want to bring home. Interest does not stop. Every day during that moratorium, from day one and continuing on to the end of the moratorium, the interest accumulates. So you are not required to pay it, but it is accumulating for future payment. So at the end of the moratorium, that amount will be waiting patiently to be paid. One of the things to note is that is how we survive. Remember, every business has its means of revenue. Yeah? For a supermarket, we sell our groceries, we collect our revenue. For a bank, how we make money is interest. So interest on loans, interest on investments. So if we have to forego the interest completely, what would happen to the bank? It will go under. So this is our revenue stream. That's any bank's revenue stream. So that is why interest, we will give you that financial break. So because if you're not working without that financial break, what would happen to your loan? It will go delinquent. So by 90 days, it will go into non-performing. And then a bank can then now sell your property. So there can be foreclosure. So to prevent all of that, we are offering you that vehicle to prevent default of your loan, where you're not earning an income, so you do not have to worry about loan payments. So that's the primary purpose, but the interest still accrues. Yeah? So the options that are provided under the moratorium, as we mentioned, we offer full moratorium where you don't have to make any interest, any principal payment over the term of the moratorium. So everything is deferred for that fixed period of time. The outstanding interest is capitalized. So at the end of the moratorium, that interest over the period, say if you're on the moratorium for 18 months, at the end of the 18 months, that interest will be added on to your last balance, outstanding balance. Yeah? So the monthly interest will be added on over 18 months, and that would be added on to your last principal balance when you start that moratorium, and that is what will happen to the interest amount. Unless you come up with a lump sum and you can pay out the interest outstanding. But outside of that, it will be capitalized. Or you have a partial moratorium, which is where you defer principal payments but you make interest payments. Now, you make your interest payments. Now, in the case, you defer the principal payment and you make your full interest payment. Now, for some persons that may not be able to make your full interest payments, we have some persons that anything they collect, they come and put it against the interest. So if your interest is supposed to be $50,000 at the end, and if you are making small payments towards it, you would have had, a reduced amount at the end. So it's important, if you have whatever little cash flows, if you can put it against the interest, that would help in the end. Oh, that's better. Yeah, thank you. Down one. So what a full moratorium means to you, and if you notice, in some cases I'm repeating because it's important, it's just reinforcement. The principal payments will be deferred and the interest will continue to accrue on the loan account. And so just to make the point, the interest is not waived. Yeah? Extension of the loan maturity date with the same monthly payment, or it may result in an increase in your monthly payment. Now we'll do an example so you can understand how the moratorium actually work in terms of dollars, an actual example. So let's look at an example. We have a loan, the original loan was at $300,000, can be ECUS. The interest rate, and that's a real example, interest rate at 7%, that's the current rate on the mortgage. The loan terms, original loan terms at 25 years, was 25 years. Monthly payment was $2,020.34. The current balance, as of when the customer came in to do the moratorium, was approximately $236,000 with a remaining term of 15 years. So the customer would have paid 10 years on the mortgage. So customer has asked for a moratorium. So what will happen if we go down that table? We will see up to 1, 2, 3, 4, the fifth line, the interest accrued during full moratorium will be $25,000, roughly $25,000 for the 18 months. That would be an average monthly interest of about $1,376, roughly $1,004 of interest will be accumulating monthly. How we calculate that? You just look at what your balance at the time of you took the moratorium, which was $236,000 by your interest rate, and that is what will be accrued monthly because the principal sum will not be reducing, which would be typical if you're making principal payments. Yeah? And so the total owing at the end, so when the moratorium comes to an end for this loan in September of 2021, the interest that would have accumulated of $25,000, that would give you a total, that would have to be added to your principal outstanding of the $236,000, so you'll get a total of $261,000. So your principal outstanding of the $236,000 will increase by the interest during that moratorium period. So your loan will now be recalculated then at $261,000 with the interest added on. Yeah? And what will happen in terms of the options? Now, once we come to the end, you've regained employment and things are better, then what we will do is, one, either you decide you want to keep your same monthly payment, and you deciding that, or we may have to decide that based on, because we'll have to analyze your current situation. So your DSR, your debt service ratio, may not allow you to increase your payment because you may have been at the max of that ratio. So you may have to leave your same monthly payment at the 2.1, roughly 2.1, what you were used to, and extend the maturity now to 18 years, an additional 3 years to keep that same monthly payment. So in order to keep the same monthly payment that you were used to pre-COVID, we would have to extend the moratorium to 3 years, noting that you would have taken the 18 18 months moratorium. Yeah? Now, in a case where, for instance, you have the leeway and you say, okay, no, I want to keep my same maturity date. I don't want to extend the loan longer. Then what that would mean is that your monthly payment will increase. So what will happen is that your monthly payment will now move to $2,342, an increase of over $200 in terms of that's your monthly payment. And the term remaining at 15 years maturity. Yes? And so that would be what your numbers would look. Let's go back, Casilla. So that's what it will look like. So if you want to keep your monthly, you would have to extend. Now, one challenge that may happen in terms of extending, if, for instance, that customer was at age 55, with a retirement age, which we use Social Security retirement age of 65, what would happen is that if you're at 55, you basically have, okay, so let's look at 50 years. So you would have been able to have your 15 years to repay, to take you to 65 if you were age 50. Now, extending it to 18 years may not be possible for that customer. We see that? Because it will take them to age 68. And so what would happen, that customer would be forced to take an increased monthly payment. Yeah? So that's some of the discussion that will happen at the end of the moratorium. And that is some of the number crunching that you can do today to help you plan out, come September, come 1st of October, what would be my option? What would be the option that I'm going to look at? How would it impact my overall financial situation? And we can have the early conversation. That is why your bank is here. We are here, 8 to 2, and we see customers after 2. So if we have an appointment, we see you. And to have the conversations early so that we can, you can have that clear in your mind how you're going to proceed post-moratorium. It's important you have the conversation and the discussion today. So no surprises at the end. So how is interest affected now due to a moratorium? Now what happens, that same example, the original loan, which is a 25-year loan, for the first 10 years, the customer would have paid $190,000 in interest. I see one person yawning. Am I very boring? No? Okay, so 10 years, so $190,000 for the first 10 years in all 3 scenarios. And so for the original loan, for the next 15 years, they would have paid $146,000, giving a total interest of $336,000 in interest payments to the bank. So after you would have to pay the $300,000 as the principal, you would have to make interest payments of $336,000. Yeah? Yeah, so that is the original loan. Now, in the case where you keep your monthly payment, where you're extending the loan, remember you're extending the loan now by an additional 3 years. So apart from the 10 years, you'd have paid $190,000. The additional 18 years, you would be paying the bank $198,000 in interest. A total of $389,000 in interest payments. That's what you would be paying the bank. And so that's a difference here from the original of around $53,000 in additional interest as a result of that. And remember, we're talking about a $300,000 mortgage. Think of twice that figure, 3 times that figure, what those numbers represent. Yeah? So that is a very small number we're dealing with there. The bigger that number is, the impact is greater. So consider that. You can use basic loan calculators online to crunch your numbers, and we are also here to assist in those number crunching. And then in the other, the option 2, to keep your original maturity, but you're extending, you're increasing your loan payment. You're looking at keeping the 15 years. You're looking at total interest of around 351. So that's a 15,000 difference in terms of interest. The shorter the period, the less interest. Yeah? So all of that, to consider that. So where you can make payments, please make your payments. If there is cash flow, make payments against your interest. It's not going to serve you, because at the end you're paying interest on interest. Okay, remember, that's interest adding on, and you're paying interest on it. That is extended over a long period. So that is the maths you have to remember. So as much as, yes, you're getting more disposable, there's more income that you can, I'm not sure what it's being used for, but your interest is going to be there, it's going to be added on, and it's going to be stretched over a long period, and interest will be paid on it. Consider those factors when making that decision. Loans in arrears, moratorium package. As I mentioned before, the performing loans, we also considered loans up to 89 days in arrears. With good payment history, we offered our customers those moratoriums. So these loans would not move to 90 days. And 90 days mean default. So we offered moratorium to prevent, especially if the customer had good repayment history. Extending arrears existing arrears on performing loans must be updated over the moratorium period. What we encourage is that some persons may have been struggling pre-COVID. So they may have had some arrears pre-COVID, but they're still employed. We put you on the moratorium, but you have now 3, possibly 6 months to catch up to make that loan current. Yeah, so that's the discussions we've had with our customers. Non-performing loans with good repayment history, as I mentioned, we also consider that in the moratorium program. Why moratoriums are good and also bad for you. So it's good, but it's also bad. Yeah, would you agree? Yeah, so it's good, but it's also bad. And moratoriums are only good if your income or cash flows are affected, temporarily affected, and thus preventing the customer loans from navigating to non-performing. So if you lost your income, or your cash flows, your business cash flows have been affected, then a moratorium is good, because it will prevent your business or your loan as an individual from going into non-performing, as we said before. Moratoriums are there to help your cash flows only, and I put that word only, not to get extra money or this extra disposable income. Because we have cases where, we try not to decline a request. When a moratorium comes forward, the loans, our credit officers, we have the discussion just to assess, especially if it's an employed individual, we have to do the assessment. And when we tell you no, it's because we love you. We hardly ever say no. And when we do say no, just know it's out of love for you. Because we are the one crunching the numbers we see. Because remember, we can see what you're not seeing. And so your bank, and at the end of the day, remember, the more interest you pay, who happier? And we still love you. We're telling you, no, we don't want you to pay a lot of interest. Because we care about our customers. Yeah? So when we do tell you that, it is only because we know that you can do better. And that we know that it will be better in the long run for you. So it's for only those who have liquidity issues. So if somebody lost income or their cash flows are affected, then you can safely take a moratorium. Outside of that, please pay your loans. Outside of that, it's really for your own financial well-being and security of your children and so forth. And it may not be this market. At the ECCU bankers, I'm hearing the discussions that customers are taking the moratorium as they're using COVID as an excuse to for more disposable income. So everybody jumping on the COVID moratorium. Yes, you're getting more disposable income. If that extra income is used to improve your property, then good, because you're improving the value of your property. But if it is used for consuming, then that's a problem. Yeah? For consumption, that's a no. So moratoriums add to your financial burden in the long run. So yes, we're saying we know it's good if you need it, but if you don't need it, it's only going to add to your financial burden. Because if you notice, the interest is added on. Moratorium is not a waiver, and I'm saying it again, and if you notice, there's things I repeat right through the presentation, and it's really there to make, the more you say things, yeah? So it's not a waiver. Interest accumulates from day one to the end of the moratorium. There's no break. We cannot take a break. We need the interest so that we can survive as an institution. Yeah? So common myths. Medium used by banks to put people in further debt. Is that true? Do we still believe that? Huh? No, after listening to me, you don't believe that anymore. Huh? Banks provide this option as a financial relief during a difficult period. And that period is really COVID, and that is why the regulator came out. When we were concerned, whether we can offer more extended moratorium, the regulator came forward and said, no, we have to support, our communities. So that is why the moratorium was discussed, and it was extended to 18 months, just so that we can provide the necessary support. And as I mentioned again, interest, the whole myth that interest stops during the moratorium, that's not happening. Yeah, so the interest, you all can run your calculation, your interest on your mortgage, whatever your principal outstanding, you can calculate what that interest is, that is the daily factor and the monthly factor, and to know what that overall impact is on you. Now, your bank has offered, and just to break down what that 100 million in moratorium, what it represents, 43% of that 100 million went into commercial assistance. So relief we offer to our commercial customers, just to ensure the survival of those sectors. Student loans, 2%, that was a small percentage. Real estate was 36% of that portfolio. Personal at 5%. Refinance at 3%, tourism at another 11%, and commercial would entail some of the tourism. That 11% is really a few villa owners, some smaller individual loans in that sector, and the non-performing at another 1%. So you can see really is the commercial, which a lot of it is tourism, restaurant, hotel, and then you have the tourism sector, and real estate, which is the most significant in terms of individuals. A lot of individuals with their mortgages, etc., were also impacted. So the impact of COVID on banks, we have been impacted, not just NCBA, but right across the region. When we have discussions at the ECCU bankers, it's the same cry. I was on a call about a few days ago, and it's the same consistent cry right across. When a bank offers moratorium, what that means is that monthly cash flow that came in from all our borrowers just suddenly stop. So if we are accustomed of collecting, say, 5 million in payments, that 5 million has stopped for now 12 months. So that's cash flows we depend on so that we can function. The good thing for NCBA, we have very strong liquidity. So we have a lot of reserves that it has not affected us. So your bank maintains acceptable liquidity ratios, notwithstanding the last 12 months. We have some banks that are not in the same situation. We have some banks that are looking for liquidity. Yeah? But we are stable in terms of that, notwithstanding of offering the moratorium, and that's liquidity. That's not profits. Yeah? So in terms of profitability, all of us affected. One of the reasons why we are affected is that the moratoriums, we had to increase what we call provisions for possible loss on those loans. So if those loans that we've offered 100 million, if those loans go bad, we would have to be able to make a provision and put an allowance. That is an expense that goes against our revenue, and likewise the bottom line. It affects the bottom line. Yeah? And so that's what we call a bad debt expense. We have to put against, based on the moratoriums offered. We were prudent. We started the moratorium, that expense, that provision, in 2020. So we're not waiting for 2021 to get the full impact. So we've already started being proactive in that regard. Go back up, Priscilla. And so just to speak on the profitability, is we heavily reliant, and what we see into, the market interest rates have reduced. We had to give rate reduction. We had to work with customers, particularly our commercial customers, to ensure that they survive that period. So some concessions will have to be made. And so all that will affect the bottom line. And not, as I said, it's not a situation just for NCBA. It's a global thing that all banks are being impacted in the same way. Yeah? So just to, any question before we go into some money management tip, which is critical during COVID-19. Any questions on the moratorium? Did it answer the questions that you had in your mind? Just let's get a 5 minutes of some 10 minutes of questions, if there are any questions before we go to the last part of the presentation. Good night, Delcy. If you pay off the interest? If you pay off your loan, there are standard penalties that banks would apply. Our penalty is 6 months interest. Yeah? 120 days interest. If you pay off your loan, which we hope that will not, nobody pay off their loan with their local bank. Yeah? Your local bank, we're not happy to receive checks where you're paying off.
We're talking about interest all the time.
Oh, the accumulated interest.
No, most is stressing on interest all the time.
Yes.
What comes in my mind, if there will be a penalty if you pay off the loan before the time. That's all I'm asking.
Okay, so there's 120 days interest, which is standard across the sector. Yeah, that there will be a penalty if you close off your loan completely. But if you're making principal payments against your loan, like small amounts or whatever, once it's not paying off, there are no penalties to do that. Yeah? But you can't come and just put a 5,000 against your mortgage. There's no penalty to do that. Yeah, at least for NCBA, there are no penalties for you to make advance payments on your principal. Any other question? Yeah, we clear on the moratorium? Yeah? Yes? So I can move on? So just some tips. That presentation, maybe I can call one of my staff to come and present that area. Anybody wants to? Because we as a team, we run similar sessions, on money management. And so that would be familiar with my team, because we recently did a presentation on money management. I see Karen, you want to come up to do it? Okay, so we spoke about, for instance, your money. When we talk about money management, we're really talking about your income. So now we're speaking on a retail level, on an individual level. So that income that you earn in, that income has to do a number of things. If you notice, we have only 4 jars here. But we know for some persons that may be 10. Like for me, it's 9. So some persons may be 10, some persons may be 12, some persons may be 2. But the reality is that income needs to stretch to cover several things. You have retirement that we all must plan for, because we may live to retirement, so we need to plan for that. We know that Social Security will not give us our pre-retirement income. You will never get, if you retired pre-retirement, you're earning 5,000, you will not get a retirement pension of 5,000. We all know that, yeah? We're going to get a reduced amount. And for most of the regions, it's at a third of the amount. So we have to plan to fill that gap. So that is why other pensions, like you have employer pensions, it's always wise to go on those additional pension plans to fill that gap. So retirement, we need to put a little something aside to meet that. Housing, we need to put something aside to meet our housing, because a lot of times, apart from that 100% financing that we offered, and not in every case we could have done it. With some persons, when they came in for the 100% financing mortgage loan, they had other loans that they wanted to pay off to consolidate. So we were giving 100% financing on house and land. But if you add in other loans that were unsecured, then that would make it not, because it's not strictly mortgage. Most persons did not have, yes, they know I want to build a home, but persons did not have no funds to pay legal fees, to meet not even a 10%, which is the normal requirement of a mortgage or purchasing property. You'd have to put down a 10% deposit. We have to start to have that jar, to start to put aside that jar to cover at least 10% of that loan amount. So if you buy in land of 100,000, you should have in your mind at least 10,000 to come forward to the bank, your 10% equity injection. Yeah, so putting a monthly amount to build that nest egg is important as you plan your finances. So that's a jar. Vacation, let's go to college, education. For us, either for yourself, if you're a young person and you want to advance yourself, that education fund. If you have children, we need to start to plan for our children's education. Too many times we see when our children get to 18, what we have to do for all of us. We have to go to the bank and remortgage our homes. All of us, and then at our retirement age, our mortgage is done and we have to remortgage our homes. Why? Because we did not plan for that eventuality. Our children did not just reach 18 years. Remember, they didn't jump out at 18. They jump out at a day. So we know, or even when we were pregnant, we know in 9 months they were coming. So we need to start to plan. And sometimes I tell myself, I wish I got that education when I was 18 and 19 and 20. I got that realization very late in my 20s, late 20s or maybe early 30s. So the persons receiving that information in their early 20s, that's the opportune time to start to build those retirement funds, because you put very little and you get very large nest eggs, as you have a longer period to build that nest egg. So where at my age, I would have to put in a sizable amount monthly to achieve that nest egg that I'm now looking forward to. Now, if you had that plan 20 years ago, you would be putting a lot less. So it's important that we start early, the early planning. So that's why the jars are important. So as soon as we get that first month paycheck, or even the paycheck this month, we got paid already? So we're still in April. When come the end of the month, we can start these jars in terms of allocating in the right way. Vacation, we always have to live a balanced life. Life is not just about paying bills and stuff. We have to have extra. And that is why even throughout the Come Home promotion, I have done so much talking in that period. Casilla can tell you, we've had several counseling sessions, which was very, very good, because one of the things we have to ensure is that a mortgage is just one small aspect of your life. It's the most important financial decision any of us will do, because it's a sizable investment. But it should not be your only, like when you take that mortgage, you cannot do anything because you've maxed out. So we've taken a mortgage, we've maxed out our income to pay that mortgage. We cannot do the other bucket. So all we can do is pay a mortgage. Because by the time we max out on our debt service to get that home, every home comes with what? Property insurance. What else? Property tax. What else? Maintenance. And the bigger the house, the bigger the light bill, the maintenance. So by the time we do all of that, we have no monies left to do any of the other planning. So it's important that when your bank give you that financial counseling, not that we don't want you to have a grand nice home. We want you to have a grand nice home that suits your income and that you can survive beyond that mortgage. Yeah, so it's important that we consider all those factors. For those persons that are starting out, that are coming now, we want them to take on that advice so that they can make proper financial decisions about their future, because you can have your startup home or you can build an expandable home where you can add to it as your income grows over the years. We don't have to have it today. Yeah, so the mortgage planning is something that we need a lot of conversation on so that we can make better decisions around that. And so that planning, and so all of that will enable the balance, that life, that vacation planning. And I believe in that little part there, that little jar must be there to put a little something that you can get that balance that we need. Yeah? The 3 buckets of money, how we have to see those buckets. Now we condense it to 3 buckets. We have the static bucket, which is all the past decisions that we've made, all those past commitments. Remember, for the past, we cannot change that. We already have the mortgage. What can we do? We can't tell the bank, I want to reduce that mortgage. I no longer want that big mortgage. I want half of that. We can't do that. So the past is the past commitment. So that's one bucket. It's a static bucket. But what we have influence, we have control over is the control bucket, which is our current, our present choices. What we do today and going forward is what we have control over. So our present decisions today is what is going to help. The dynamic bucket, again, is future. The wants and needs is as we plan forward into the future. So these buckets, we have to see, okay, today, the past, the present, and future. And future will entail your retirement planning and all the education planning, etc. Building long-term wealth, making the right. Basically, that future bucket will help you achieve that passive income that we need to achieve in order to achieve financial freedom. So the only way we can achieve financial freedom is by ensuring that the investments we make today can generate income to allow us to stop working. So when we stop working, our income from our investments can support our day-to-day living, that we are not reliant on an income. So that's that future bucket, that's a dynamic bucket. So it's important to look at that. So without money management, this is where we'll be. You see this? Please stay with me this month. We'll be screaming and crying at that salary. And we don't want that. How many of us, when we have a little money saved, that we feel good? How many of us? When we have a little money saved, we feel good. When we have nothing saved, how do we feel? You're scratching our head, I see one person. Yeah, so we want to move from that cycle and move to the cycle where we have that control over our income. It's not going to be easy, because if you remember the static position, your past commitments, you would have to now sit with your bank, see how I can restructure. That's where you do your debt consolidation. See how you can reduce your expenses, have conversations with the family, sit down with the children, have the tough conversations, so that you can tailor that income to reduce where you can start to plan. But we must do it, more so in this current environment of uncertainty. So some good signs, 8 signs for good, that you are good with money, and these are some of the signs here. you have steady flow of income, so you're employed, or you have a viable business. You know how much you spend. Some persons, you ask them, they don't know how much they spend on groceries. We go through that when we do your statement of income and expenses, when you're going through a loan. And persons would have to, they don't even know how much money they spend on groceries. You have to break it down to weekly. And then they will say, okay, I think weekly 200 or 400. We need to know those things. And that is the only way we can know that is through budgeting. We have to get into the habit of budgeting. Now, it's not easy, but you have to put the tools in place to allow you to get into that habit. It took me a long time to get into the habit. But as you get older, the realization starts to hit home. The children start to get nearer and nearer to 18 years. And, you have to make the decisions. So we have to get something that will drive and motivate us to make that change. But the change has to happen. Oh, no, change, yeah, that's not. You can buy things you want. Yeah, you can buy things you want. You have an emergency fund, and that emergency fund is very, very critical. Now, what that is that in the case of an emergency like we are in now, where you would have lost your income, say you lost your income this month, you based on the rule of thumb that one should have had 6 months of expenses saved up. So if you would have worked 10 years in your life, 10, 12, 15, 20 years, over that years you should have saved up a little bit monthly, that you would have accumulated 6 months of expenses in an account that will be for emergency. So COVID comes, you are out of employment, you can sustain yourself for 6 months. But now we're into a year, then, now I can understand then the financial pressure start. But if you have an emergency fund, that will help you through a few months to survive a couple months before. You have a plan, you plan to make your purchases. You are saving money. And based on, I know we've had other sessions about basic rules that one should follow in terms of guidelines by financial planners, is that one should save at least 5 to 10%, preferably 10% minimum of their income monthly. So, and one should also see saving as a compulsory expense. So the same way we see paying our mortgage, doing whatever we do on a monthly basis, we have to start to see saving as a compulsory expense. You invest to make more money. And the only way we can invest is after we've accumulated wealth. Some saving, you've saved, you now have a lump sum that you can now diversify into other investments. We can go. We can stay here, but a little bit. Just to touch quickly on this slide. This slide, a lot of times we meet with persons and persons say that they cannot save. Or we put you on and we tell you that how many times do you eat out every in a week? Some persons will say every day I eat out. Now eating out, if you're earning in EC dollars and you're eating out in US dollars, what's happening there? We have to do the maths. Even my daughter sometimes tell me, Mommy, it's only 12 US. And I tell me, multiply that by 2.7, baby. Multiply by 2.7, you'll see how much that is in EC dollars. Because sometimes they think $12 is 12 EC. But it's not. So we have to do the maths and see the amount. So that calculation here, if we cut back, particularly during COVID, if we want to really set up that emergency, that COVID budget, we can start to cut back on some areas. We can cut back on in terms of if we spend a lot on clothes, we can cut back here. If we have driving less, we know ourselves, we know our habits. It may not apply fully for Anguilla because it's a small space. If we go out less, just saving 100 US a day for the month, if we go out a lot and we cut back 100 US, look at the lump sums we would have saved over a 20-year period, 124,000, 25,000. In 10 years, 44,000 save up just from 100 US monthly. At the savings rate, 2% savings rate, EC savings rate. If we go to the groceries for us women, we take $100 less in groceries. This is good. Look at the kind of savings. If we, by going to the, huh? So let me tell you, I'm sure some persons have heard me talk about, I just came from Montserrat. I used to live in Montserrat for 5 years. And comparing Montserrat to St. Vincent and even like the Eastern Territory, St. Lucia, where I am from, I went to Montserrat and went to the supermarket. I remember my first time buying eggs, because I love eggs. I mean, for breakfast, that's what we have. So a dozen eggs in Montserrat is 16 EC dollars. If you have a good friend, after many years, I got a good friend that I could have gotten it from for $14, you know? But that's a dozen eggs. So I had to share an egg with my children. I mean, there's no wastage on egg, because that's a dozen eggs for $16. But I come to Anguilla and I can eat plenty eggs. I mean, because right now I'm buying eggs at $4.50. You can get $4.50 a dozen eggs. That's EC dollars. I mean, so context. You see, it's context. So I am coming from, you know, so I shouldn't be saying that publicly. But you see, but the reality is, at the end of the day, it boils down to, you know, your budget, your income, yeah? So for instance, in Anguilla, rental is way higher compared to Montserrat. So, you know, so in Montserrat, rental was at, you know, a third of what you get here. There are areas where Montserrat was more expensive than here, than Anguilla. Yeah, so it all depends on what sectors, as you say. But the important thing at the end is to do work within your income. Because sometimes when we shop, we don't have to shop for brand. We can shop for price. But some of us, when we push our trolley, I had a friend I remember shopping with her, and she was saying, if I'm not concerned that you don't have Kellogg's in my trolley because I took the cheaper brand. And I tell her, Kellogg's, I mean, what my children know about that? I mean, I give you cornflakes, what you know? So it's what, you see, is what we get our children accustomed to in terms of taste. You make them like it. So you give them it from, you start them with Kellogg's. If you now want to go down a brand, they will tell you, my son will tell you, Mommy, that's not the same thing. Because they know the taste. So you start them with the cheaper brand. And so then all they know is the cheaper brand. Because when the pocket cannot afford the Kellogg's, then I know I'm good. Yeah, so we have to, the thing that is all about the dollars and cents is decisions. If we can afford it, go ahead. But if we can't, our incomes cannot support it, we have to amend accordingly. And so that's the bottom line. So no matter where we operate, no matter the cost of living or the standard of living, we just have to adjust. You understand? Some islands you live, like I remember in Cayman, I spent a couple months and it was exorbitant. So I had to adjust. So there are some places where it's cheaper, you enjoy. Where it's not, then you adjust. So it's at the end, it is really balancing, making the decisions versus what you earn. Decisions versus what you earn. So what to do in this crisis is really reassess your spending, as we just spoke about. Prioritize essentials. Food, health, safety. That is what we should be focusing on. Eliminate spending like the big ticket, the luxury items. We can hold back on those decisions. If we can afford it, we go ahead. Replace more expensive brand, and we're just speaking about that, about the brands. So we are not repeat that. Cash is king. And I tell persons, even for instance, particularly our commercial customers, where you have cash, it doesn't make sense drying up your cash. Work with the bank. Let your bank know what your situation is, your cash situation, because cash is king, particularly in an environment like now. Yeah? So if you can still take your overdraft, your line of credit, and you have your cash there as a cushion, if worst case that your cash, you use up your cash. But cash is king in the current environment. Reassess your debt situation. Speak to your bank and about what options are available. Take advantage of moratoriums if you need it to prevent your loans from going into non-performing. Identify opportunities for saving, long-term investment if you can't do that at this time. And also, what I have then, retool yourself, and that's the whole, taking care is self-care, etc. during this period. Some final tips. Start building a cash reserve, at least in order to start that saving. Let us do it. You know your current situation. So let us do whatever ways we can so we can see how best we can start to build that emergency fund. Apply for a moratorium on payments only if required, and again we stress on that. And if you are on moratorium, start making interest payments if your situation has improved. Because from the bank, we don't know your situation has improved. But if your situation has improved, it's important that you come to the bank and say that I would like to restart my payments. We would love to see more of that. That if persons have things have improved, even though it's not full payment, but whatever interest payment you can make would help your situation in the long run. So also remember we were talking about the income. It's not a matter of how much money you earn. Is how stylishly you spend that income. So how stylishly we spend that income will decide our fate at the end of the month. Whether we'll have a surplus so that we can plan ahead, or whether we'll have a deficit that would basically not give us the comfort that we needed, that financial comfort. And I always leave this last slide. How many paychecks do you have left? Now, I see some person smiling, the person that are familiar with this slide. This slide goes way back to 2005. I think that's when we first used that slide. And it just shows you what happens to your paychecks. The arrow is not going up. The arrow is going the other way down. And so at age 25, I wish I was still there. I would have 480 paychecks left. I wish I had that still. That's all we can say, we wish. It's gone. Now, by the time you see the blue area, when you're 40 years, you have 300 paychecks. So you're still good. Now, when you reach in the red zone, like people like me and a lot of us in the red zone, at age from 45 down, 240, and if you notice, I put 65 here just to show you what the paychecks look like at 65. So at 65, what will kick in? Your pensions. But that nice fat paycheck that you earn when you are working is no longer, if we do not plan properly to continue on that nice fat amount that we were getting. So the paychecks are going down. So planning, the financial planning is critical in all aspects. As we talk about, remember, financial planning is broad. We have to look at estate planning. We have to look at, the whole setting up will and just your whole insurance planning is critical. So all those areas are critical. And one of the things that we will do as we continue the seminars is to touch on what a financial plan will look like for an individual. Factoring insurance, so maybe I'll call on my colleagues in the insurance industry to join in on that. To look at estate planning and so forth. So we are going to cover retirement planning, etc. So we are going to cover a lot more as we move forward in that seminar series. So we have about 15, 20 minutes. So we can take some broad questions, whatever the question is. Before we do that, NCBA, we are here for you. I mean, we are celebrating our 5th anniversary on the 25th of April. That's next week. We're going to be starting off with a church service. We want to invite the whole of Anguilla to join us. It's really a milestone. When the NCBA, when we were formed, we didn't think, 5 years down, we were not thinking 5 years down. We were trying to, set up a new bank coming out of the failed 2 entities. And today we can stand strongly and say that we are a much stronger entity today. Yeah? And then we'll have quite a bit of activities. As I said, we'll start off with the church service on the 25th of April. So everyone come join us. It's going to be a really good church service. Where Details on where? Huh?
Church of God of Holiness. Church of God of Holiness.
Okay, Church of God of Holiness. So that's where
Elizabeth Avenue. On the Queen Elizabeth
Elizabeth Avenue. So we're going to have that church service that will start off the week, and then we'll have quite a few activities in the following week. But there'll be a lot going out on social media, radio, etc., to speak to some of the events that we are planning for the 5th anniversary of the bank. But it's going to be big. So there's a lot that we're going to be announcing over the next couple days and weeks. Yeah? So questions? It can be anything. Any questions? Anything coming from social media, from Facebook? If we have questions from there, we can take it. Oh, they love. Oh, Lord. My St. Lucian accent, huh? Oh no, I mean we are offering for new loans, new mortgages, that's the rate, 5%. Yeah?
The old ones can be restructured.
Yeah. So, but I mean, you have the conversation. Have the conversation.
Yeah.
We cannot guarantee that, because if we have to, it's just like, for instance, if you have a business, you have, say, a commodity on the shelf at, say, $5 selling, because you bought it at what? You bought it at $3.50. You're selling it at $5. You were able to get another shipment at, say, $3, so you can sell the next shipment at, say, $2. But if you now go across the board and reduce everything, you know what that can mean. So that's the same concept. Remember, bank, we are the same. I mean, anything that happens, our income is affected as a result. But on a case-by-case, matching with your risk profile, when we do an assessment of you as a borrower, we can, we can see what we can do. But the important thing is, at the end of the day, is to ensure that you have the conversation with your bank first. We don't want you having no conversation with no one else. Have the conversation with your bank. NCBA is our bank. It's the people's bank. That's our bank. We have to keep the bank strong. So any conversation, if you're not happy about something, come in, call myself, call Casilla. Let us have the discussion first before you look or have any discussion with any of our friends in the market. Okay?
Maybe this is not a question for you, but you're taking the questions. Globally, the whole financial world has reduced interest rates. Mm-hmm. But in Anguilla, I think you were touting all through the seminar that the interest rates have to continue, mm-hmm. because the bank have to survive. Mm-hmm. Now, the bank is a business, of course, and 99% of us in here are business. Mm-hmm. So the interest rates have to continue. We're into COVID. We can't find the money to pay our loans. Mm-hmm. So where are we going to find the money to pay the interest? But globally, the whole world has reduced interest rates, except Anguilla.
Okay.
All right?
So thank you for your question. So globally, rates have come down. Likewise, for the region. The difference with the ECCU region, we have what you call a minimum savings rate that is mandated by the central bank. So for every dollar of deposit, EC deposit that we hold, we must pay our depositors 2%. In other parts of the world, those developed countries, there's no minimum savings. So those banks, they even charge you to keep monies with them. So if you look at some deposits in the US and other markets, the rate of interest is minus, because they're charging you to hold your funds. They can do that because there's no minimum savings rate. There's no rate that they must pay to depositors, whereas we have that. Now, and so that is why in the US you'll have mortgages at 3%. If we have to offer 3% mortgage, but we must pay out 2%, that's it. if that is removed, if you, I didn't get your question. Oh, that's a dormant account. Yeah. No, remember, we paying you 2%, not you paying us. We paying you 2%. Yeah, so the dormant fee is for if there's no activity on your account. Because remember, that is a huge risk. An account to just be for bank and there's no activity. We have to maintain that account. There's a cost to every account that we hold. Yeah, so, and even for instance, the update, right now there's a lot of requirements to update customer information. So having an account just dormant without a customer coming in, it can have implications for the bank. So we basically have to put a fee to sort of, cover all of that cost and to deter dormant accounts, to encourage people to come and reactivate. Yeah? But that's not a customer induced. That's not a customer induced deposit. Because remember, I'm not seeing you. I'm paying you, but I'm not seeing you coming in to transact on the account. And remember, you have a 2-year period before it goes dormant. It's 2 or 3 years? 3 years? 3 years. In 3 years, you should come and do something to your account. Once you do that, there are no fees. Remember, we can not pay any dormant fees. We just have to do one transaction we're talking about every 3 years. Yeah? 2 to 3 years. I think it varies based on accounts.
I think it's important to note that the money that you actually have belongs to the people, and it's not yours. And so the people expect return as well. For one to put money in a bank, there must be return as well.
Oh, yeah.
So I think that is very important for us to understand. But one of the things I wanted to mention was the fact that, we speak about a lot of negatives about COVID-19, and I myself would tout that at times on Facebook. However, there are some positives that we need to look at. We now come to a point where we have to restructure our lives and how we do things. Exactly. I recall some years ago, my mom had a friend, a head teacher friend of hers, they were colleagues, and he had one light burning in his house, and we would laugh at the fact that he had one light burning. And I find myself now burning that one light. I find that my house, while it have about 5 televisions, I ask my children, once we are all on CNN, why not we gather in one room?
Exactly.
And, so there's a social gathering now. We begin to discuss and share with each other, not only we look at television. So there's some positives in this, but I admire the fact that the session on savings and how important it is that we don't run away with, but understand that savings is so important.
Yeah, thank you so much for that, Mr. Richardson. Yeah?
Under the financial information month, you were supposed to look at, the islands were supposed to look at retirement savings. And it would be, I did hear you mention it tonight, and I think that would be a very, very good idea. I know many a times when we talk about retirement savings, we're more thinking that we're talking about older persons. But it's so important to get our young people as part of those groups, and I hope that in future when you actually dealing with the topic, that we actually look at our youth and get them involved, because you're right, if you start saving from very young, I find that when you get old, you won't have to be thinking, when I retire, what I'm going to be doing. And you find a lot of persons when they retire, they have to go back to work and all these different things because they don't have funds. And to me, that is quite hard, because at that point in time, you should be enjoying life. So I really like the topic.
Yeah, excellent. Yeah, thank you for that. Yeah.
There is a phenomenal program that the bank currently has, and it's called Gold Achievers Savings. So for those of you who don't know about it, once the COVID period is over, I would encourage you to invest in a Gold Achievers Savings account. That too, I think, is good for a retirement account.
Excellent.
Am I correct?
Oh yeah, thank you. Thank you, Mrs. Richardson. Yes? Yeah, so you didn't hear from me. You heard from a happy customer. And the rates are higher on a gold savings plan. And and you can use it, yes. Because it starts from a 2-year, 3-year, 4-year, 5-year, so you can actually, set up that. And very small amounts, as low as 100 EC, you can start up an account. And the interest we pay, the interest rate is higher than what we pay on the normal savings, which is the 2%. We pay more on the gold savings.
He has me nervous now that he has that camera right in my face. Just a question. On the encouraging of like the college fund, the student funds, I know that NCBA had a junior savers account plan.
Yeah.
I think it was very limited. I don't know what you've done since, in the last 5 years to make it a little bit more attractive, because still have one. I do not know what to do with the monies now, because it has reached the max where it could reach, and it's a small fund. It's like $2,000.
Okay.
And if you're saving for your child from zero, then that's, in 2 years, that's maxed out. So the question is, what arrangements or differences you've made to encourage the college savings fund?
Yeah. Okay, so that is one of the areas that we are looking to improve on. So for instance, one of the products that we're looking to launch, again, COVID has delayed the launch of it. We are looking to do a home savings plan, just to help people that want to start saving today for home construction or home acquisition. We're also going to look at an education, re-look at our education plan, and also a retirement savings plan, an IRA, individual retirement account. So all of the wealth products, we will set up a wealth product that will capture all of those areas. And so even, for instance, as you speak to children's education, it has to make sense that you can save to that lump sum, because when you look at education, you have to be at 100 and more thousand in order for it to make sense. So we have to re-look at that plan as we plan ahead. So that is something definitely we are looking at. In terms of time frame, I cannot give specific time frame, but that is something that we can look at least within the next 6 months. We can launch. What we want to do is launch a wealth management package that will capture all the areas that you need to be planning for: education, retirement, home construction, etc. So that's the kind of thing that we want to launch. Yeah. So and my chairman is there, my director is there, so all that's approved already. Yeah. 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 So. But that is something we're considering, just to make sure that we meet in every aspect of your life, that life cycle of an individual. We are planning for that. Yeah? So any more questions? But I like the point that Mr. Richardson made about, for our homes. And remember in the conversation, it's important at this time, because you have parents saying that, but it's my children, or like, who's in charge of the home? We are in charge of the homes. So we decide what happens there. And so all these, like, even for instance, I tell persons, I remember at a session I had, and I tell persons, my children have their separate rooms. My daughter reached teenager and she wants a separate room. But I tell her that there'll not be 2 ACs running in the night. Somebody need to be sleeping together, because I have a boy and a girl. So come when sleep time, 1 AC working. So both persons on the bed in one room, but they have their separate rooms. Because I can't afford to pay an AC running 8 hours in the night and another 8 hours over there. Who's paying that? No. So we have to be in control of our households. We make the decisions. And you made a good point. You have 5-6 TVs at home, and everybody scattering one watching. We have to come together, and in order to cut back, and that's ways to cut back. Anglek may not be happy with the conversation, but it's a conversation, yeah. But these are things that we can do, and these are immediate things we can do. That's things we can change like this, because we are in charge of our households. Because that's one thing I told my daughter from very early coming into Anguilla. I told her that there's no way your allowance you got in Montserrat was 5 EC. Mommy can't do more than that. There is food in the fridge. You come home at 12, you're going to eat home. There's no buying of, we have to make the decisions. And she'll tell me, but mommy, my friends, they're buying food every day. I said, mommy can't afford it. That's the reality is we have to make the decisions. We are the owners of the house. And so we make the decisions and the children have to, they follow. So the budget is the budget. And we work with the budget. And every now and then I break the little rule every once in a while. But we set the base, we set it, we set the tone. And if we don't set the tone, we're not in control. And one thing to note, a lot of times people feel that because our incomes are not high enough, we're not making enough. But I can tell you it's not about how much you make. It's how stylishly we spend it. Because we can get an increase tomorrow, and what happens? Suddenly our vehicle too old. We now need we need a later ride. We need a bigger this, we need a bigger that. So it is not how much. Because I've seen very big incomes and people still they live in hand to mouth. And you see the smaller incomes and the people managing. So it's not how much you make, it's how you manage that income. That's the bottom line. Yeah? Any further comments, anything else that we want to mention before we close off? But you found it, useful? Yeah? Yeah?
Yeah, Charmaine, I personally want to commend you for the efforts, especially your explanation on financial management. If I were to grade you, I'd put you way up in the 90s. I myself, I'm a financial planner. Matter of fact, I'm a certified financial planner. Mm-hmm. So I understand the things that you reference. Mm-hmm. One of the things I hope that we can do in the future is to bring in the aspect of risk management.
Okay, excellent.
Okay, which would help bring all it together instead of the areas that you went on. So the risk aspect of it, the risk management aspect of it, you need it in. But otherwise, that's a fantastic job, and I must commend the bank for its efforts. Thank you.
Yeah, thank you. And I have, as you say, risk. We have our risk expert right here, Stefan, in the audience. So, he will take on that next challenge. Yeah.
Fantastic.
Just in terms of bringing risk from a personal level, and also risk in terms of small business management, small to medium size. But it's a critical topic. Yeah. COVID has brought a lot. The dynamics have changed. And so we really need to be doing things differently. Yeah? So I want to thank, I'm not thanking, we have someone thanking, Delcy. Jeff, okay. But just to remind you of the 5th anniversary, we want all on board. Church service, let's come and praise and pray and sing along. We want all our customers to come and celebrate. If you have been, without you, we would not be here. And so we really appreciate the support that Anguilla has given to NCBA. Right now we're at 65% market share. In terms of the deposits in Anguilla, 65% of that is in NCBA. Yeah, and a lot of that, we didn't start at 65%, is over the years, over the last, I would say, 18 months, we've grown by over 100 million in new deposits. And that speaks to the confidence in the bank. Yeah? And we want that confidence to be reflected in the loans growth. We're leading in terms of loans, but we need all Anguillians to come home. Come home to your bank, have the conversations, and let's make NCBA bigger than it is. We want to make it a regional bank. We are heading very, very close to the 1 billion EC dollar mark. We are at over 800 million in terms of asset base. With more persons coming on board, if we can grow our loans base, we can make NCBA a lot stronger than it is today. So let's keep pushing, and collectively we all benefit, because it's really Anguillian owned, and we can keep it Anguillian as we plan ahead. Yeah. but we need all hands, all persons to participate in that growth. And I'm sure you've heard the conversation around the sale of the bank. That's a conversation. We have a seminar. I'm not talking anything about that, but we have a session coming up on the 29th, I believe, the Thursday. I think it's the 29th, where we're having a sort of a town hall session where we're going to be speaking to the history of the 5-year of the bank, 5 years of progress. In that presentation, we'll be talking a little bit about the whole, I mean, you've heard about the divestment of NCBA, the ownership. So we'll be talking a little more about that. So we want everyone to register. We are going to have that session at the secondary school auditorium, because we want a large room. We want 500 and we want thousands of people. Everybody stand seat. We just want everyone present where we can talk and discuss the progress of NCBA. With their mask on, I was reminded, social distancing. Okay, but thank you so much for listening, both on social media and, you know, for bearing with me for the last hour and so forth. So, Jeff, over to you. Thank you so much.
Good evening, everyone. A wise man once said, it does not matter A wise man once said, it does not matter where you go and what you study. What matters most is what you share with yourself and the world. This is truly indicative of what we have witnessed here this evening. Firstly, I would like to give thanks to the Almighty God for making today's event possible and a resounding success. Our presenter, Ms. Charmaine Francois, CEO of NCBA, we would like to say a heartfelt thank you for such a timely and informative presentation. I am sure all of us would unanimously agree that she is deserving of another round of applause. To our most valued invited guests, ladies and gentlemen, and to those of you listening via social media, we say a heartfelt thank you for taking the time out of your busy schedule to be part of this event. Thanks to Titanium Sounds for the use of their PA system and microphone, and in Anguilla for streaming of the seminar. To our caterers, Larry Catering, for the delectable refreshments that were prepared for your audience. We say thank you. Thanks to the management and staff of the Teachers Resources Center for the use of the conference room. Last, but by no means least, we say a heartfelt thank you to Summit Consulting for contributing to pulling this event together, and to our NCBA credit team for their support. We say thank you for your support this evening. To everyone who has contributed in one way or another, we say a heartfelt thank you. I'll leave you with one last note. Be stubborn about your goals and flexible about your methods. Thank you.
So refreshments, I think, on the outside. Yeah, thank you.